My name's Derek Ballantyne, CEO with Encasa Financial. I'd like to welcome you to the session we're holding this afternoon, at least this afternoon in Eastern Time. Appreciate everybody making the time to join us. This is a first for Encasa in the way in which we're trying to create an opportunity for you as investors to have a more direct interaction with us and to have the opportunity to come face to face with some of the folks who work tirelessly with us to produce the results for you that we have. Before we get much farther, I do want to acknowledge that I sit in Toronto, and I'm on the traditional territories of many Indigenous nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat peoples. And Toronto is currently home to a large number of other Indigenous peoples as well. In making this sort of land acknowledgement, we're always asked to reflect a little bit on what the path of reconciliation has been for each of us or for our organizations. And for us, I think increasingly it is to give deeper thought to how we might achieve one of the recommendations out of the Truth and Reconciliation Commission, which is around economic reconciliation. How capital finds its way in support of Indigenous peoples and First Nations in particular. Not something that even in a fund like ours that is focused on responsible investing has been sort of front and center yet, and certainly there are not yet a large number of opportunities for us to do that, but I think it behooves us to continue in that path. As I mentioned, this is a first for us. We did and have committed to greater interaction with investors in the fund. We've done that in a number of ways, and certainly by increasing the complement of advisors that we have working with you and that you can contact with on a day-to-day basis. We have been providing more information through the website. We've done a couple of conference calls along the way as well with different investor groups around particular subjects. And as we've made some changes in the funds themselves, and this is really a test to see how we can start to adapt the use of technologies, which regrettably for this year have been with us in a significant way. Things like Zoom calls like this one. I think this is a sort of an interesting time to come and have this kind of meeting. It has been a sort of a challenging year on a number of fronts. Certainly, I think individually everybody has been challenged by the impact of the pandemic, if not on our work lives, on personal lives and in other ways. And hard to understand how this is all going to play out in the year ahead of us and when we will migrate out of the direct effects of the pandemic into a sort of a greater recovery phase. And hopefully in the session ahead, we'll be able to talk a bit more about that with the sub-advisors who are working with Encasa for both the fixed income and the equity funds. And they will be introduced to you in short order as we break up into the next groups. Important before I hand this over to Audrey Robinson, who will take us through some of the logistics, is that each of you understand the disclosure that is in front of you, that this is not a discussion intended to be investment advice or relied upon in a way in which you may make investment decisions. This is a free exchange of information, opinion, and other things. But if you have particular questions, particular interest, or need assistance in those investment decisions, we really encourage you to get in touch with your investment advisors for that particular purpose and not to construe this session as that particular type of advice. With that, I'll turn it over to Audrey and you can take us through the logistics and then we'll get right into the conversation.
All right, thank you, Derek. I'm Audrey Robinson. I'm the portfolio manager for Encasa. I'd just like to remind everybody the very first lesson in Zoom is everybody needs to mute themselves. And when we get into the breakout sessions, you'll have the opportunity to unmute if you choose to ask a question. We'll talk about that a little bit later. I was reminded early this week that a year ago, we were in the early days of the shortest bear market on record at 33 days. And here we are a year later. We ended the year with markets in positive territory. including Canada, because we got double whammied with oil price war as well as the pandemic. And so it'll be interesting to speak with Addenda and Genus about 2020 and their outlook for 2021. Have with us today Diane Young. Diane is from Addenda. Her exact title is Senior Portfolio Manager, and she's co-head of the Corporate Bond Group. And we're also joined by Wayne Wachell, who's the CEO and CIO at Genus Capital. I'm going to kick it off with a question for Wayne and Diane, and then I'll be observing whether you have questions and making my way through. I will note that if we don't get to any your question, please just send it in, and we'll have one of the investment advisors respond to you when we've talked to Wayne and Diane. So my first question was, 2020 was what we would call an interesting year for investors. Di, and then we'll start with Di and then talk to Wayne. What were the highlights from your perspective vis-a-vis your markets, which were the fixed income markets?
Sure, thanks Audrey, and thank you all for attending today. Hope the discussion will be informative for you all. So 2020 was certainly an interesting year. I think that's no surprise. I think some of the highlights for me with regards to fixed income really were, if we go back to the early days of the pandemic, certainly the speed at which interest rates fell. Central banks were extremely aggressive at lowering rates and injecting liquidity into the market. So the Bank of Canada, for instance, dropped rates 150 basis points in record time. And of course, the rest of the yield curve ensued. Certainly, I would say if we think back to 2008, and even if we think 2007 to 2009 and the global financial crisis, it certainly took the central banks a lot longer to actually act and get comfortable with adding that kind of liquidity. Whereas I would say this time around, the speed at which things happened was extremely rapid. So that was kind of how we started things off. And then again, how the governments just really acted quickly. Again, from the monetary side, with the Bank of Canada agreeing to buy corporate bonds, provincial bonds, basically any asset class that, aside from equities, in which case to make sure that they backstopped the liquidity of the markets. And then, of course, what followed very quickly was the fiscal side, which we haven't seen and we didn't see to that extent in the past 10 years. We haven't seen the fiscal side of things. So the government basically saying, unemployment benefits to infinity, small business loans and moratoriums on evictions. So lots and lots of support for the layman person. That was certainly a difference than what we saw in the global financial crisis, which was really mainly in the financial system. So those were a couple things. And then, of course, Wayne will touch on this, I'm sure, is really the speed at which the markets reacted. So again, the very short bear market we saw in about 6 weeks from the middle of February to the end of March, and then at which things turned around. So in sympathy with equity markets, credit spreads roared back, tightening, again, eliminating that risk premium that we saw in February and March, and really turning things around. So the ability for investors to really look through the pandemic, which was so unknown, was really surprising to me.
Thank you. Wayne?
Yeah, I agree. Number one was the speed of policymakers. It was breathtaking in terms of how fast the central banks moved. They just pulled out the 2008 playbook and went that even faster. The U.S., they expanded their balance sheet from 4 trillion to 7 trillion in a matter of months. It was amazing. It's shock and awe, as they say, and how the governments came in as well. Two other things I want to focus as well in terms of, and the market reacted very quickly. The market is a discounting machine. It discounts information 6 to 9 months in advance, discounted the recession in the recovery in a couple of months. The other thing that amazed me by 2020 was how corporations adapted to modifying their business models, dealing with the pandemic. And the other thing was just the big thing, I think, for the year, apart from central bank and government intervention and the speed of that, was the acceleration of the digital economy. It probably gapped in 1 year, probably 4 or 5 years, and just moved on. And that's why technology did so well, because they were coming in, and the Amazons of the world and the social media and everybody were delivering. People needed technology, and so it just bootstrapped the whole digital economy in 1 single year. And in markets that had more exposure to technology, like the US, they did better than markets that were more resource oriented, like Canada. So that was the big takeaway for me last year, was how quickly things moved and adapt, and also the acceleration of the digital economy.
What keeps you awake at night these days? Wayne, we'll start with you.
Well, it's what keeps the biggest fear, I think, that most managers have, and they even asked Barack Obama this question. I agree with him, was that the return of the bond vigilantes. That the bond vigilantes was a term coined in the 70s, where they were basically bond investors, and they were concerned about inflation. So they raised up rates high, and that ended up forcing the governments to do something about inflation, because they couldn't live with the higher interest rates. And so do the bond vigilantes come back? Do we get higher interest rates? Because right now the economy is very levered to debt, and higher interest rates will shut things down. And so I'm getting some concerns. The market's starting to get some concerns now about inflation or reflation with all the spending and the vaccines coming out very quickly. So that's a concern right now. I'd say that that's an ongoing concern all the time. I would say it's been benign for some time here, but we're starting to get some early warnings on that, at least.
Di?
Yeah, certainly for a fixed income PM like me, that's certainly been a concern. However, I think if I think about it, there's a couple. If I think about what's different, what's new to our market, and I think some of the things that do concern me, and it's kind of like playing poker with someone who doesn't know how to play poker. It's new additions, I would say, to some of the markets. If we think about things like Bitcoin, if we think about the recent effect that some of the retail participation has had in driving kind of valuations in certain areas of the stock market, and kind of adding to this mania where you don't really know where the end game will be. We all believe that it will end at some point and go back to fundamentals, but right now there's so many distortions in the market, namely driven by central banks and governments intervening. It's very difficult to know, if you drill down to just fundamentals, what's kind of left over and what's really driving markets. So changes to regulations on, if we talk about Biden, is that something he's going to bring into effect? We're certainly hearing a lot about news and things like that on social media platforms. And I think during the pandemic, that was certainly something that played a huge role in the election and in other areas of our lives. Is this the way that news is disseminated through social media? And lastly, I would say a large factor that worries me is climate change. If we look at what's happening in Texas right now, it's having huge impact on our energy infrastructure in the U.S. and what that means going forward. And I think if this isn't a wake-up call, I'm not really sure what is. So that's, I think, going to be a large factor going forward.
Di, you alluded to this. The Biden administration has supported a continuation of the Trump Buy America initiative. Let's start with you, since you raised it. What do you think are the economic implications for Canada on continuing the Buy America program?
Yeah, I think that was a way that Biden was able to achieve victory in the way that he did in grabbing that area of the Trump supporters that were kind of pro-American. So he did a good job at achieving that. We'll have to see exactly how far he goes. Certainly the manufacturing sector here in Canada could definitely be hurt, especially those that have direct agreements with governments in the US and infrastructure. We do hope we see an infrastructure project by Biden's administration. I think that's where we think good money is spent on large refurbishment of infrastructure. We've been talking about that for years, that it's so needed in the US. But that could could definitely be to the detriment of Canada. Certain supply chains could be disrupted from that respect. We'll have to see how it all plays out, but definitely on the manufacturing side, I think that that certain areas of the Canadian economy could be impacted negatively. And of course, the Keystone, he was very quick to. That's not necessarily Buy American, but he was very quick to turn down that project that Trump had supported. So again, further impact on the Canadian economy due to the administration's decisions on that front.
Wayne?
Yeah, it's really hard, to put a finger on exactly where it's going to impact Canada. It's a lot of the things. There's going to be so much money sprayed around the next couple of years. Canada's going to be a beneficiary, I believe, anyways. Even if there is more of a bent towards buying U.S. by the U.S. government, and we're going to be a recipient of, I think, as energy prices go up and demand for global products go up. And it's a global market anyways. And so if they're buying more steel or cement to build infrastructure, it's going to help our resource-based areas anyway. So I don't see it as being that bad, any worse than what Trump was doing. And the XL Keystone is, could be a blow to Canada, obviously, but I don't see a big impact here.
Couldn't it also be a benefit to Canada? Because that XL pipeline gives a $25 billion a year cracking premium to Texas. If we refine and move that crude across the Rockies and across Canada, that cracking premium stays within our economy instead of the American economy. And as far as the market crash goes, there was no fundamental issue with the market. The pandemic closed the market down. So we're faced with government intervention, as you already noted, and the climate, which is probably our most serious threat, because it could get in the way of any petroleum production, export, etc. But the actual fundamentals of the economy were never in doubt until the pandemic hit us.
Yeah, no, I'll go ahead. Yeah, no, I agree. Until the pandemic, the economy is doing great in the U.S. in particular. We had a slowdown in 2019, and the central bank was on the case. They were providing liquidity and trying to stimulate the economy. So there was a recovery taking place, and we were in our portfolios. We were loaded for it. We saw it coming, and then the pandemic hit. Bang. In terms of the issue, I think too, at least for Alberta, who wants to export, is there's been complaints coming out of Alberta, obviously. I guess the issue is there, even if stuff stays in Canada, can they actually distribute that across the Rockies and back east is really the issue too, right? So it's a complicated issue.
Yeah, that's what I was just going to add, was it's moving the oil even within getting it to where it needs to go is certainly the biggest problem.
Yeah, I think they have an idea on how to deal with that, though, is they're inviting First Nations participation in the ownership of the Trans-Canadian pipelines, which, of course, is fundamental to one of their primary issues.
Yeah.
So, Wayne, I have a question for you from Jeff. Jeremy Grantham says we are in classic bubble territory. And I guess bubble territory primarily in equities, although I think we've been in bubble territory in fixed income for several years. What are your comments? But are we in a classic bubble?
I would say no. There are areas that are bubblicious in the market. Definitely, there's some. There's some of the ESG stocks and Tesla and those kinds of things. I don't get some of those valuations. But if you look at the market and look inside the market, it's very different in terms of some of the areas that are hot, some of the areas that are cold. And we look at stocks in terms of looking at stocks that are value based. The overall, if you look at the market, if you look forward to 2022, people are using 2022 earnings because that's looking through the valley into a recovery, then the hopeful new horizon, right? So based on 2022 earnings, the market's trading at around 20 times, maybe about 19-ish today, with record low interest. Interest rates are still very low. So from a valuation perspective, you could say on an interest rate adjusted basis, that ain't that bad. There are areas that are hot. I get that. if you look at the cheapest, the 20% of the cheap part of the market, the cheapest part of the market, 20%, the average PE on the cheap part of the market is around 12 times earnings on 2022 earnings. So there is still value out there. A lot of the growth areas have done really well. The value is still to be realized. And normally that value area, which trades around 12 times right now, would normally be around 15, 16 times. So there's value in ability to pick stocks in this current market, but there are some areas that are just crazy. And as Diane said, there's been so much money pumped into the market, into the economy. You get this dysfunctional, crazy behavior. We can see stocks like GameStop go to 250. There's technology involved in that as well, of course. But you get a lot of dysfunction, and you'll get accidents. People will get hurt. Things will blow up, and they can actually destroy liquidity that way. So there are areas that are hot, but there are areas that still are value the way we look at it.
Do you want to comment on yesterday and today in the equity markets, and what's the sell-off, particularly on the tech side?
It's part of the rotation. I just think it's the realization that basically the U.S. is opening up. I think it was J.P. Morgan a couple of days ago said they see herd immunity in the U.S. in 40 to 70 days. So that's reality. If that opens up, everything, it's game on. And I think you're seeing some of the air come out of the tech sector, which has been the big winners of the pandemic. And as well, Bitcoin got hurt. Janet Yellen came out and said she had concerns about Bitcoin being good for transactions. I think it's down 20% last I saw in the past 2 days. Some of the tech companies, PayPal, companies like Tesla are starting to get exposure, Square getting exposure to Bitcoin. So that's helping drag them down as well. And just you see these kind of changes in sentiment. So it could be a change in sentiment and a move towards more value reopening type stocks.
Stephen, you have a question?
Yeah, for Diane, I'm wondering if Wayne just mentioned Janet Yellen. Does Janet Yellen not ameliorate your concerns of your inflationary concerns? Her ability to handle and deal with inflation, it certainly was her prime worry for many years, and she now sits in a very strong position there, I think. And I guess I'm wondering if Mr. Trump's infrastructure week is actually going to happen in the Biden timeframe.
Yeah, we've been talking about it for a while, haven't we? Yeah, it's interesting to see Janet Yellen in a different chair because, as we know, she was in her tenure was really fighting inflation or deflation. Sorry. And we believe, it's funny, Wayne says, that the equity market has this great ability to look forward and look, years down the road. And the bond market doesn't seem to act the same way because they're looking very near term and getting very concerned about, we would call it transitory or, reflation. What can they really, inflate the economy? They've been trying for many, many years. We've been talking about inflation, certainly most of my career. And it doesn't seem to, I think it was back in 2011, we did get core headline inflation up, mid 3.5%. Did it last? No. Right now, inflation expectations are being driven all by the reopening trade, but also by fiscal stimulus, which is different. But I guess I would ask, our concern is that you have massive amounts of debt now overhang, corporate and government debt, that once we do go through the reopening and you run into the wall of the fiscal cliff or how now do they start weaning people off the fiscal stimulus? How do you now say, okay, even if you're not back to work, we're going back to, the times of old where you get, very minimal unemployment benefits, et cetera. So we do think that she will continue to talk about inflation. The one thing that the Treasury and the Fed have is tools to fight inflation. They have all the tools to fight inflation. It's the deflation that they've struggled with because they've got rates essentially rock bottom and they pulled out all the stops on monetary policy. So they're kind of at this point maxed out other than yield curve control and their just rhetoric that they can talk it down. So she will continue to talk about getting inflation higher and reflating the economy. The question is can they do it sustainably over 2%. They haven't been able to for a long, long time.
I would just say that
Thanks.
she's in a different position. She had independence when she was the head of the Fed,
Sure.
and she doesn't have now. She's taking directions from Biden and the administration, and I'm concerned. I don't think she has the same independence she had back at the Fed. And I think if the reopening trade comes and they just keep spraying money everywhere, there's going to be some issues, and she can't. I don't think she can stop that. That's my concern. I think it's concern of maybe the bond market too.
I think the concern to the equity market would in fact be, and it comes full circle, is the fears that happen in the bond market eventually will make their way to the equity market through higher rates, because we know that the equity market is being fueled by low rates. So there is a tipping point where rates will go high enough, and that will then filter back, and then valuations don't make sense in the equity market. So we've seen it on the way down with rates being in a bull market for so many years. And have fueled the equity market. And we'll see, if we in turn are in a reversal of that, how that feeds through.
We have 2 minutes left. If anyone else has another question.
Do you have a view of the debt GDP ratio for 2021? And I'll note that we're 54% for 2020. So that's got to have an impact on everything you've just said. If we're afraid of all of these social interventions, and yet at the end of the day, 54 doesn't move much beyond, let's say, 55, I don't know what the impact is. Do you have a forecast on debt service?
It's not, rates are very low. It's not that bad right now. It isn't really an issue in Canada, I think. You can jump in, but I just say in Canada, our debt to GDP is low compared to everybody else. Yeah. U.S. it's low. It's not a problem here. Let's keep it. Let's keep a lid on that. But we have luxury. Germany and us have very low debt to GDP. The U.S. is now pushing through 100. Italy's accelerating. Japan's through 200 and going crazy. Those are issues longer term that the U.S. is going to have to deal with. I believe the debt to GDP in the U.S. is going to approach about 120 soon, where it was after World War II. And to get that down, we've done a bunch of simulations. You have to get the deficit as a percent of GDP down below 2%. And the inflation rate helps because it grows the GDP, right? And so you need real growth and you need some inflation. It's all good. You just can't let that inflation genie out of the bottle too much. You have to be careful, because that can actually impact the economy with higher interest rates.
Yeah,
right? So
you've got $1.3 trillion of clawback that Biden has available to him right now. And that's the tax gift for the wealthy. If he claws that back, there's 1.3 trillion that helps fund prior to increasing the borrowing, the credit ceiling, which is one of his options. I think he may come up against the ceiling in the next year or two.
You have 17 seconds, 15 seconds to respond.
I was just going to say, it hasn't been a problem. I think Wayne makes all the facts there. We call it a consequence. They've been able to issue a lot of bonds, and they're, again, we think about it down the road. There's probably a consequence, but near term, it's probably not a big concern.
So bond managers have been sort of managing returns and talking about, the most risk sitting in balanced portfolios is in the bond portfolio because of interest rates have been so low. What are your comments on that? We have 2/3 of Encasa investors are in the two bond funds, which you manage. What's your advice to, the folks that are invested in those two funds and going forward? The long end of the yield curve is going up. The short end is sort of, I think you mentioned, is controlled by the central banks. What are your concerns?
Yeah, the returns we saw out of the bond market last year, near 10%. We certainly can't expect to see that again. As much as I'd love to say past returns are an indication of future. I can't say that. Certainly, as yields fall, the opportunity for returns out of the bond market, are diminished. However, I think the recent period we've seen where rates have backed up a little bit, does give us opportunity and an opportunity to take advantage of those higher rates and then see better returns down the road. We're sitting in negative territory so far in 2021, which we don't typically see in the bond market. Usually those kinds of returns are limited to a quarter or two. So we would expect a reversal, and we'd expect, but again, to your point, if we see the Canadian 10-year yield is about 1.35%, or sorry, US 10s are around 135, and we've got Canadian 10s around 126. That is the indication of future returns, is usually the 10-year yield. Add a little bit of credit to that. We're talking 1.5% to 2% is probably what we're forecasting for this year.
Okay, thank you. Yeah, I'd forgotten to mention that at least January was certainly negative, and last year was certainly a bonanza for.
There becomes a little bit of an argument. This is maybe a bit of a plug, but of return, return of capital rather than return on capital. And if you're worried about excess returns in the equity markets, sorry, Wayne, there is still obviously a place for fixed income assets in a portfolio.
Diane, just sort of coming back to you, I think Wayne, you alluded to this, and I think I read something that long end has gone up by 50 basis points, but the long end is at less than 2%. 10 years are in a normal environment. 10 years, are you in the range of 4, 3, 4, 5? So what's the norm in a normal bond market? What would you see 10-year yields at?
Well, it's hard to say what a normal market is, because we've been in a bull market in yields for going back 20 plus years. So I would say it's been steadily falling. Pre-pandemic, we were certainly in the 2s, but 10-year yields and Government of Canada yields will be driven off expectations for growth and inflation. And growth, although we talk about the economy was good pandemic, it wasn't 4% growth. We were talking about sub 2. So right. That's kind of where we end up, is that and as we accept more debt and debt to GDP continues to grow, that will borrow from future growth. Just like a normal person is, if they've got credit card debt, you can't keep borrowing. The governments have proven they can certainly add to that, but it does dampen future growth. And so where do we expect yields to go? I think it's going to be very hard for the global economy to digest higher rates with now this new and improved level of debt we've tacked on.
Right. Wayne, you want to add anything?
Yeah, I would just say, typically we look at the real interest rates, the real 10-year rate, for example, and pre-2008, that financial crisis, they were up around 2%. So you take inflation, if it's 2%, you add on 2% real rates, you get 4%. Post 2008, real rates have been around 0.5%, and they've recently been around 0. They've traded in this very narrow range between 0 and 1. We think we're stuck, as Di says, in that range forever because there's so much debt out there. We're going to have very, very low real interest rates. So maybe tack on a 0.5 point to a 2.2% inflation. I can see maybe conceivably getting a 2.5% yield handle maybe later on this year. And that would be sort of back in the sort of the old trading range, I would say. That's a long ways from where you are right now, but I think it's conceivable we can get to those levels if everything's back in place. I think the economy can sustain that as well. And so, but I think we're condemned to low real interest rates for a long, long time. Just with the debt, as Di said, it's an issue.
Hans, did you have a question?
Interesting. Yeah. Okay. I'm not on mute. Interestingly enough, actually, Diane and Wayne kind of just touched on it, and it was regarding the interest rates and where they're going to go. And so that was kind of, that was discussed, but I'm wondering just the sensitivity of it with respect to the huge amount of debt that has been taken on. Sort of where do we see that if interest rates, kind of go into this point, then it's going to have a significant impact on the on that debt piece that's been taken on and create a problem for the equity market?
Well, I would just say right now, if you look at the U.S., I'm not sure of Canada, and correct me if I'm wrong, Di, but from what I've seen, the average interest rate on U.S. debt right now is about 1.75%, which is very low. And so if they're going to probably tack maybe another 5 or 10%. So it's not going to change that much. And rates are very low right now. So it isn't an issue yet. It's a longer term issue. So I think that isn't a threat yet, but I think maybe 3 or 4 years, 5 years out, if we did get a big burst in rates, the new debt coming out for refinancing would be impacted. But I don't think it's an issue right now.
Di?
Yeah, I mean, I think we would disagree a little bit. I think that that the equity market is a bit vulnerable, and certainly to Wayne's point, there are areas of it that are more sensitive. And I think that truthfully, if you correlate the S&P 500 with the Fed's balance sheet, it's like a 95% correlation. It's extremely strong. And so it does appear that the monetary stimulus, the buying of bonds, which is suppressing interest rates, continues to fuel the equity market. Risk assets in general, we could correlate high yield assets with that as well. So I do think that a bigger concern is how the Fed and the central banks continue to support the market. And we've seen the Bank of Canada today came back, and it's very small, but I think it's a signal that they came and said they're reducing their provincial bond buying program from 500 million to 350, and they're reducing their the tenders on the corporate bonds. Now, they haven't utilized these programs to their full extent by any means. They haven't had to. But just that, we would call that tapering. They're removing liquidity. Typically, when they do this, or when they try to do this, whether it be raising interest rates, tapering their bond purchase program, we've seen the market react pretty wildly. And 2013 was an example. 2018 in December was an example where the Fed has then had to kind of go all in again. And so I would say that higher rates again would be basically could be a result of this. If they were to pull back on some of their programs, you do get that volatility that could leak into the equity market via higher rates.
One of the ways that governments can deal with the debt to GDP is basically, I think we talked about this in the last session, as long as interest rates stay below the growth rate, by definition, the ratio comes down. Or we did talk about this, which is inflate our way to a lower ratio. What are your thoughts? And I think, Di, you and I have had this conversation before, which was one of the things that the governments can do is extend the duration or the term of their debt outstanding. And I'm so curious, how are governments, and particularly in the developed world, taking advantage of, even the low yields at the 10-year, and Wayne, you can weigh in as well, to kind of deal and manage with the debt to GDP ratio?
Well, certainly they've been really good at doing that. I mean, the provinces are notorious for being able to fund themselves at excellent funding levels. And, if you look at the duration of the provincial index, it's much higher than Canada's and corporates because they do issue such long-term debt. And so absolutely, these low coupons for governments to issue debt, they are extending, and corporates are doing it too. Lots of corporate bonds, corporate names that used to come to the market with 3 and 5 year deals, they now do 7 and 10 year deals, even longs, to lock in those low coupons. So it's absolutely happening, which does contain that debt service cost for sure. So we do try to look at that as well. And that is relatively manageable. And the funding levels, for the governments right now is exceptional. And so you're right, as long as it does stay in this lower manageable area, I think it's just hard to know, if we look at real rates, that they are creeping up. And I think, that will be the real test. Where is that line? Where's the sensitivity on real debt?
Okay. Wayne? Yep.
Yeah, I think, all the jujitsu of monkeying around with the maturities can help cut the cost. But if you really want to turn the debt to GDP level down again, we have to start balancing budgets, or at least bringing them below 2% of GDP, I would say. And we need growth. We need growth. And I think inflation, will help, because that grows the overall economy as well. And that was part of the problem the past decade. We had some decent real growth. We had no inflation. If we had another 1 or 2% inflation in the past decade, that was the Fed's problem. They undershot inflation the whole decade. If they had 2% inflation more, the economy would probably be 10% bigger than it is right now. And so they own that. And Jay Powell confessed up to that about a year and a half ago. So they're going to get more inflation because they want to grow the GDP, the numerator. So they want to grow it, and they're going to redline it. But it's usually the way most governments get out of their debt problems is through inflation. That's just, if you go back through time, centuries and centuries, it's what they end up doing. And the question here is, will the bond market allow them to do that? And the bond market, unfortunately, in places like Japan and maybe in the US, is starting to become more controlled by the central bank than investors. So we'll see what happens.
Do you guys have any closing thoughts? Wayne, do you want to comment on the change in the equity fund investment objective that we took place last year?
Yeah, I think it's one thing is, I think just having more U.S. exposure gives us opportunity to play more of the technology space. It's very limited in Canada. Canada's a very limited market, just in terms of heavy concentration on energy, which is a declining sector, I would say, longer term, maybe not next year or so. And then a big exposure to our Canadian banks. It's just so concentrated in those areas. It gives us more areas we can diversify into in the U.S., as well as more areas for creating wealth. There's just more opportunities there of companies coming up that we can hopefully buy and add value for our clients.
Great, thank you.
I first want to introduce Brian Mims from Addenda, and you can throw your hand up in case people haven't scanned across her. And Mike Thiessen from Genus Capital. Mike is part of the equities management team, Brian the fixed income team. Both obviously have been active in implementing the responsible investment policy that we have. I'm fearful Mike might have disappeared from us, but in the interim, what I thought I'd do is sort of ask Brian, starting with you, there you are, Mike, to reflect a little bit on what, in the context of responsible investment more generally, what has 2020 been like, and how do you see things evolving in the year ahead?
Sure. Thanks, Derek. Yeah, so it's a pleasure to be here. And just to clarify, yeah, so I work with Diane, who's in the other room right now. Her core fixed income team manages the short-term bond fund and the bond fund. And then my team, the sustainable investing team, is responsible for making sure that we adhere to your responsible investment policy. So maybe, Derek, I'll just do one quick second of how that process works. And then we can go into our outlook for this year. So in basic terms, the way the process works is our sustainable investing team has to make a determination for every issuer in the portfolio of whether or not it meets the needs of the responsible investment policy. So we're evaluating each of the issuers and looking at the restrictions, both the more hard restrictions around tobacco, for example, as well as the sort of controversy focused restrictions as well, and evaluating each issuer and make sure it meets the needs of the two funds. And we can go into more detail on that later, I think. But in terms of what things are looking like for the upcoming year, I think it's super exciting times in responsible investing right now. I think there is just so much interest in the marketplace that we're seeing across all different asset classes, across all different approaches to responsible investing, be it best in class or screening or worst in class screening out. Responsible investing, looking at engagement activity, integration approaches. So there's just so much appetite and interest in the marketplace, and we've sort of reached this this interesting tipping point where at the beginning of this pandemic last year, we participated in a few different surveys, and people were asking us, do we think we'd still be talking about climate change in a year's time, or are we going to be spending all our time talking about the pandemic? And I think we've just seen such a ramp up of an interest across the board. So, we're participating in doing work around climate change for sure. And now we see issues like biodiversity starting to come to the fore as well, as investors are really starting to think even more broadly about the different sort of environmental pressures that we're facing as a society, and what can we do about it as an investor. So I think it's super exciting. There's obviously a ton of capital needed to address some of these challenges that we face. So, I think as a bond investor and also in equity markets, but we see where there's a need for capital to help address some of these challenges. So we stand at this point in time where it's super exciting, but we have to keep the pressure on in terms of making sure that we maintain some level of standards. We keep our focus on what's important and make sure we understand what our clients are looking for and what the actual people that we're investing in are actually doing with the money. So are they marketing themselves as green? Are they actually green, and that sort of thing? So, it's going to be an exciting 2021. I don't think our team's ever been busier in terms of the requests and the information that's being sought from our clients, but also especially our investment team. So they're becoming much more interested and super engaged in this dialogue as well. So it's a very interesting time.
Great. Thanks, Mike. Mike, over to you. And just before I let you go, just a reminder that if you have a question, you'd like to pose it, you can either raise your hand through the sort of find where you can raise a hand and it pops up on your screen, or put the question into the chat room and we'll be sure to address that question. Mike, sorry, over to you now.
Great. Thank you, Derek. So 2020 was an amazing year for sustainable investing. I think that there was a big influx in interest in sustainable investing. There has been for a few years, but then 2020, it really took off. And I think that's due to a few different factors. I think one of the factors is that in crisis, people are reconsidering what's really important to them, what their priorities are. Do they want to be supporting certain industries or certain sectors or not? So kind of reprioritizing that. I think another factor has been, performance. In 2020, most responsible investing funds in the equity world did very well. And I think a reason for that is just that a lot of, during crisis, people really need solutions. And a lot of these companies that we invest in with responsible investing, sustainable investing, or impact investing are providing solutions to some of these big problems. So I think that is why there's been a big, that's why performance of a lot of these funds has done really well, and just the influx of capital into these funds. And I think for 2021, something that I'm really excited about is just that we're seeing more and more companies developing more sustainable practices. And some of them are doing that because it's great marketing. Some of them are doing that because their investors are really pushing them that way. So there's a lot of investor engagement with a lot of companies. But then other companies are doing it because their employees really want it, or they really feel like it's a core part of their mission. And so that's exciting for us as investors, because it means that that the overall sustainability of what we're investing in is getting better. But then it also means that we have more options, more companies that we can invest in. We see our overall investable universe continuing to grow. And we think that's great. More companies are kind of fitting into our screens, which is good. And I think that's just going to continue. I think as, culturally, people are demanding more from companies and want more transparency. So I think that's really positive. There's a lot of other great things happening in 2021 for sustainable investing, but that's probably the thing that excites me the most.
So, Mike, have we finally put to rest that argument that has danced around responsible investing for, since it really started, that you can't get the performance out of responsible investment portfolios that you can out of the broader market? Have we finally sort of slain that dragon?
That's something that we've been kind of preaching for years. But I think finally people, the mainstream is starting to really believe that. We've been doing studies and back tests for a long time. We have a 21-year back test that we do every year, looking back all 21 years and looking at how well sustainable portfolios would have done, specifically portfolios that have low carbon intensity, how well they would have done. And in Canada, the US, internationally, all these different regions, they would have actually beat the market if you were to just focus on a low carbon intensity portfolio. And so I think people are starting to really catch on to that. I think performance really speaks. And like I said, 2020, a lot of responsible funds did quite well. So I think people are catching on, yes.
Yeah.
And maybe, Derek, I could just chime in on that one. I mean, I think that I helped, like it was like 15 years ago, we did a little study on performance at the time. And even like just last week or the week before, there was yet another meta study came out. I think it was New York University Stern School. Like they looked at 1,000 studies looking at corporate financial performance, corporate social performance, and like 70+% are like it's positive correlation. Others are neutral, and then there's this fine little bit of residual where there might be a little bit of a negative showing up. Like I think we can put that one to rest, but I think we continually get the question though. Yeah.
So Brian, can you in this market find the product that fits that responsible investment set of criteria that we're interested in? Are debt markets sort of mature now, and can you find those issues that fit into a portfolio like this?
Yeah, so I think it kind of goes back to the different parts of your policy in particular. So you've got there's some impact orientated part that you've got in there, and then you have more sort of an ESG integrated approach as well. So we've got both pieces in both of the bond funds. So I call it the sustainable bond part of it, what we would call the impact side of things. Yes, we're finding enough product to build that up. So I think it's roughly 20% of one of the funds and roughly 30% of one of the other fund. So we're finding enough product to build that out. It's not supposed to be a pure play impact portfolio at this point. We're balancing that off against other financial objectives, but we're also looking for issuers that meet the standards that are in place as well. Some of the other screens that you have in place in terms of things like controversies around corruption or fraudulent practices and those sorts of things. So we can weed out a lot of those companies that we don't think meet your standards. So we're using some inputs like, we're screening the portfolio using our Bloomberg to identify real-time sort of controversies. We're using inputs like an MSCI ESG to help identify controversies and make sure that we've identified those and cut them out of the portfolio. But on the positive side, yeah, I think we're seeing a fair bit of issuance. Like this morning, I was on a call with a European issuer that's looking at doing Canadian dollar issuance, and they have a social bond framework. So they have affordable housing, education, so public education, and they have health related as well as job creation in their social bond framework. And they're thinking about issuing in Canadian dollars. So we're continuing to see these opportunities sort of emerge where we have an opportunity to put capital to work.
Mike, the concern we always have with these things, when there's such a sudden interest on things like responsible investing and ESG, that there's always a fear that, the product is not genuine or that there's sort of a level of greenwashing. How do you actually measure and how do you manage that and how do you protect against that in the portfolio?
Mm-hmm. Yeah, there's been a big influx in greenwashing. I think a lot of asset managers, banks are creating these green funds that aren't actually that green, but it's amazing marketing right now. So they know they can get more clients if they label it green. So I think the most important thing is to actually look in the portfolio. And if it's supposed to be a tobacco-free portfolio, make sure there's no tobacco in there. Or if it's supposed to be low carbon intensity, make sure there's no coal utilities, things like that. Those seem really obvious, but we've seen cases where they've actually violated those kind of core values for their funds that they've set. And so I think there's a whole bunch of different metrics that you can look at. If you're looking at something that's more environmentally sustainable, we always look at carbon intensity for equity funds. So this is looking at the carbon emissions that a company has relative to millions in sales. So carbon intensity can range from 10 or 15 from a tech company or a financial firm that have very low emissions per million in sales, to thousands or tens of thousands for utility companies. And then so for the MSCI World Index, the average is about 190 for carbon intensity. And for the Encasa portfolio, it typically is between 40 and 60 kind of range, so quite a lot lower than MSCI World and the benchmark as well. So that's a key metric to look at when you're looking at green portfolios. But I think the core thing is just to look at the holdings and make sure that you agree with what's in there.
All right. So, Brian, can you take us through a little bit what a process looks like for you if you're picking something and selecting a sort of, let's say, a green bond or a sort of an asset into the portfolio? What does that process look like for you?
Sure. Maybe I'll do two processes. One would be a green bond and one would be a non-green bond, so just sort of a regular holding. So from a green bond perspective, we would be made aware of it by our investment teams or directly by one of the dealers, and they tell us that an issuer has put out a green bond framework. So the green bond framework outlines what the issuer has proposed to use the proceeds for of the bond. And if it's a framework, then they're saying they're probably going to come back to the market multiple times and try to get some funds to fund different things. And they'll itemize within their green bond framework what the use of proceeds could be. So if it's European Investment Bank, for example, they're going to use it for renewable energy or energy efficiency projects. If it's a City of Toronto or a City of Ottawa green bond, it'll be a longer list of possible items. And sometimes they'll give us an indication of, well, yes, our list, we have 7 different possible use of proceeds, but we can tell you that it's going to be used for the new LRT in Ottawa, for example. So they'll have a framework, but then they'll usually give us some sort of indication of how the proceeds will actually be used as well. And so my team will then evaluate each of those green bond frameworks, and we'll look at the use of proceeds. We'll look at the current disclosure. We will look at the documentation that goes with the bond to make sure that it's actually written in the term sheet or some sort of similar documentation to make sure that we have some sort of legal. We don't have much recourse, but we do want to see that they've written it in, that they plan to adhere to a green bond framework. And then we'll get some assurance from them that we're going to get reporting on how the proceeds were allocated and what sort of impacts resulted as a result of those projects in the future. So at least once a year following the issuance of the bond. So we'll evaluate that, make sure it lines up with our focus areas from an impact perspective. And then we will internally, we'll tag the issuer or the security or the framework as an impact investment. And so then the investment team knows that it's an impactful investment and they can add it to portfolio. So whether it's an impact only portfolio or a portfolio like the Encasa portfolios, where there's a preference for those sorts of securities, they're aware of what makes sense from that perspective and where they can look to try to add more of those sorts of impacts. So they have access to that whole list of all the securities that have been tagged.
Yeah.
So that's on the sort of green bond impact side, but then the other side would be called a regular sort of bond. So when we initially were brought in to manage these two portfolios, we evaluated all the companies that were in the portfolio, as well as the companies that our investment team wanted to transition into, and made sure that we could identify those that did and did not meet the standards of your responsible investing policy. So we set that up, and then we have set up the monitoring to keep track of those issues going forward. So there are a number of companies that we've decided are not eligible for the portfolios based on those policies, and we continue to monitor the portfolios over time as well as we go to make sure that no companies that are currently in the portfolio start to not meet your policy. And if we have not yet reviewed an issuer, we have to review it before an investment team wants to add it to the portfolio. So when a new issuer is coming to the market that we have not traditionally purchased or has not come to the Canadian market before, we have to review them and approve them or not approve them.
Right. So, Mike, we talked a lot about energy, green, those sorts of things. Obviously, there's an S in ESG, or the social part of it. Have you been finding opportunity that to find securities that fit the social criteria or that social part of it? And if you have, what does that product look like? What are those kinds of securities that you're finding?
Yes, yeah. So we're finding a lot in environmental, as you said, but then we also have a lot of companies that are making a social impact as well. Social is harder to find than environmental, at least right now in the market. When it comes to social, we look at things like education or nutrition or healthcare. When it comes to education, it's relatively difficult to find. Once in a while, we do have one in our portfolio. For nutrition, we do have some, but healthcare tends to be the bigger weight for social impact. And there, we're looking at companies that are providing solutions to major diseases around the world. So we're looking at solutions to things like cancer or cardiovascular diseases. So there we have companies like Bristol Myers that the large majority of their revenues are coming from solutions to solving some of these major diseases. With healthcare companies, there's always some controversies that come along with them. So we have to be very careful with these healthcare companies, making sure that there aren't anything severe or widespread, making sure there's not even, moderate controversies, but there's always going to be something that's more minor, and that's something that we need to be investigating in and keeping on top of. But yeah, those tend to be the key social areas for us.
Sure. And we do have a question. Do labor practices factor in, or is that an element of the policy that is used on the screening for security selection?
So I can talk from the equity side. So for us, when it comes to labor practices, we look at that in two different ways. So we have that in kind of baked into our actual financial models. We'll have social scores of companies. And included in those social scores are our labor practices. So the companies will actually get a worse financial rating if their labor practices are poor. And the reason that we do that is we've done a lot of studies showing that companies that have better environmental and social practices tend to perform better in the long run. So even our non-responsible investment clients, we still have this in our financial models. So we do that. And then we also look at labor practices as a screening tool. So if a company has poor labor practices, then we just won't invest in that company. And then beyond that, we also look at controversy. So we look at, is there some one-off big controversy that this company has? If so, we won't invest in it. Some companies are going to have some minor controversies. And those are things that you can't entirely avoid with large multinational public companies. So those are some things that we have to stay on top of, like I was talking about with healthcare. So there's three different ways that we're looking at labor practices there.
Sure. Brian, do you want to add something to that?
Well, sure. So I think, so one way we look at labor practices is from an integration perspective. So labor practices sometimes are identified by our investment teams as one of the top 3 to 5 environmental, social, or governance issues that they're considering for a company. So that's one way that it can factor into a decision. And the other way is similar when we're looking at the overall labor practices of an issuer or looking at controversies. So again, this is where the sustainable investing team is looking at individual companies and individual issuers and trying to identify issues that might not meet the standards for Encasa. So for example, I'll give you an example. So one of the companies that's not, so we have an auto manufacturer that's not currently approved for Encasa, and one of the reasons is around labor practices.
Okay. So I know we may run short on time a little bit, but can you talk a little bit about the balance between sort of drawing a hard line and saying you're in or you're out, or trying to work with a company to improve their track record and use the fact that we're investors to try and move the needle on their practices, and where you see those tensions and where you see the benefits in doing that?
Sure. So from our perspective, so we review each company, like I said, and we've got a few different reasons or categories we put an issuer into. So if they have one of the business practices that are in your policy, then obviously they're out. If they have egregious bad practice or egregious controversies, then they're out. But then we have this level just below it where we say we're going to engage with an issuer. So we did just move an issuer into ineligible, but that was after a couple of 2 different sets of conversations with the issuer about labor practices, as well as health and safety practices for the issuer. So we met with them the middle part of last year. We met with them again a few weeks ago, trying to get better information from them about how they're helping their employees be safe during this pandemic. asking them about to what extent they had. So after the first meeting, they went out and they got independent report to give them some advice on some improvements to make. And then we met with them to see how they had implemented those. And they had not made enough progress. So we decided that they should no longer be eligible. But our hope is that for those borderline companies, if we meet with them several times and encourage them to adopt a better behavior, it's a possibility that we could leave them in the portfolio, with the end result being that they would have a better practice around the ESG issue of concern.
So Brian or Mike, it's a toss-up question. ESG.
Well, so ESG, so environmental, social, or corporate governance factor. So an environmental factor could be like the carbon footprint. A social factor could be around workforce and workforce policies. And a governance factor could be executive compensation or an independent chair, for example. But
or diversity on boards.
Or diversity on boards, for example.
Right. Add to that, Mike, anything in the ESG definition?
No, I think that you covered it well, Brian.
So, we have two questions, I think, related, and I'm going to weave them together for maybe, Mike, you can start. One is the question is around what major secular themes there are in ESG. So I think more sort of how do you map the ESG theme through the portfolio, and what are some examples of companies that stand out? So individual securities that might be selected into the portfolio on that basis.
Sure. Yeah. So we have a few different steps to our overall process. So first, we start out with a universe of basically the benchmarks that we have, and then we do screening. So we're taking out companies that don't meet the responsible investment policy, the Encasa RI policy, making sure that that everything is in line. And then once we have that investment universe, then we're applying our financial models. And within our financial models, we have ESG criteria. Because we believe, and our studies have shown, that high ESG companies tend to outperform low ESG companies. So even in our portfolios that are more conventional, we still have this in our financial models. So we apply our financial models, and then so there's kind of those two different levels, and then after that, we're also looking through each individual company, making sure that they don't have any controversies that are too widespread or too severe, and look at a few other kind of risk factors around ESG as well. And then for examples, so for examples right now on kind of the environmental side, a company that we've had for a while has been Vestas Wind Systems. So they're a company that's out of Denmark. They design and manufacture and construct wind turbines. And so about 17% of all wind energy around the world is produced through a Vestas wind turbine. And so they have had great scores from an ESG perspective, from an impact perspective, and also our financial models really like them too. So that's kind of that's perfect when all of them agree. So that's one on the environmental side. On the social side, I talked in the last session about Bristol Myers. So on kind of the social impact side, we tend to focus on a lot of healthcare companies. And Bristol Myers provides solutions in areas of like cancer or cardiovascular disease. And like I was saying before, they have a lot of healthcare companies will have some controversies involved. I don't think you can be a healthcare company without having controversies. So with a company like this, we have to really stay on top of these controversies and be quite strict and make sure that that nothing is even moderate when it comes to a controversy, and certainly not severe or widespread, or else we wouldn't have them in the portfolio. So those are two that come to mind.
So you mentioned scoring. Can you tell us a little bit about what metrics you're using when you're scoring companies? Is it an external metric? Is it somebody else doing that?
Yeah, we use a variety of different scores. So one of the scores we use is just kind of a broad ESG score, environmental social governance score, that we get from MSCI ESG research, and also we get it from Sustainalytics and another provider as well. So we're kind of cross-referencing all of these data providers to make sure that they have quite similar scores and we're not missing something. But then within this last year, we started a net impact score. So here we're looking at the positive impact that a company is making. So not just trying to cut out the companies that are doing poorly, but we want companies that have good net impact. So when we're measuring positive impact, we're looking at what percentage of revenue the company is making is from highly impactful activities. So if they have an educational product that is 80% of their revenue, then we'll class that as an 80% impact investment. And then we also measure the negative impact. So we do that in the same way, but we look at the percentage of revenue that's coming from negative impact activities. So things like tobacco or gambling. And then we'll put those things together and we'll get an overall net impact. And so if you look at an index like the TSX, the average net impact is actually negative because within the TSX, there's a lot of high carbon intensive industries that tend to score quite negative. If you look at MSCI World, so that's the index for developed markets around the world, its score is about 3%. So that means on average within that index, 3% of revenue is coming from a positive impact activity. But then if you look at the Encasa Equity Fund, it's around 10%. So a lot higher than its benchmarks, meaning that about 10% of the revenue is from highly impactful activities that the companies are doing. So those are kind of the core metrics that we're using for impact and for ESG.
Brian, on the fixed income side, similar approach in terms of measurement and
we use some of the similar sort of inputs. So we, also an MSCI ESG input. We're also using other forms of monitoring from a news or controversy perspective. In our case, our sustainable investing team interprets the results of those things and decides whether or not something will be in or out of the portfolio. And that's a separation of the duties there between ourselves and the team actually building the portfolio. So we have the full autonomy to make a decision on whether or not we think an issuer meets the needs of you as a particular client. In terms of sort of positive sort of themes we're seeing in the portfolio, so between the short-term fund and also the universe mandate, we have a fairly high level of exposure to impact investments. So these are investments that are generating positive social or environmental impacts that we've qualified. So I think the index is around the 4% level from a weight amount, and the universe fund is close to about 30% in this case, I think, for the Encasa one. So we have quite a high exposure relative to the index in these different sorts of securities. In terms of particular securities to highlight, so on the health and wellness side, we've got, for example, a couple of bonds issued by the Hospital for Sick Children. On the education side, universities, we have a number of universities represented. So out of BC, University of Toronto, York, Ottawa, for example. And then we have a sort of a preference when possible to own the credit unions instead of the big banks. So we have fairly high exposure to some of the credit unions that are available, but the biggest portion by far is on the climate change side. So yes, we have some social exposure, but we have a lot of exposure on renewable energy or clean transportation, for example.
Not Laurentian University, I hope?
No, we do not own that one.
Yeah. So you cited some examples there, Brian. Mike, on your side, are there some examples you can sort of standout companies where you see very high ESG scores that you sort of think are worth mentioning at this point?
Well, I previously mentioned Vestas Wind and Bristol Myers. Some other ones that we have right now, we have. We're getting more into solar. We're getting more into hydrogen. One company that we bought a little while ago was Ballard Power. They have a great overall impact score, and they're really making big strides when it comes to hydrogen energy. And we're actually on the private side, we're actually looking into different hydrogen investments as well. So that's something that we have been focusing on the environmental side. Yeah, I think those are some highlights.
So we are going to close out in a couple minutes, but the obvious question for us, and have you ever been able to find anything that fits the portfolio in the housing sector, the affordable housing sector?
So we have two investments in affordable housing. We have the City of Toronto social bond that was issued last year. So the social bond, there's a couple different pieces going on with that one. One is it's going to build 1,000 shelter beds. But there's also a redevelopment that's associated with that bond in Toronto. So that's going to lead to some affordable housing, some transitional housing. It's a whole suite of housing related solutions, is my understanding, in Toronto. And then Toronto Community Housing is another one that we own. And we're also open to so the mortgage-backed securities that have a social. There's a series of social related mortgage-backed securities that we're on the lookout for, but there's not a ton of them out there sort of trading regularly at this point.
One hopes that they will come. Mike, anything on the equity side that comes to mind?
On the equity side, it's very difficult to find companies in affordable housing. We do have companies that are focused on green buildings and green housing. So a company called Berkeley Group, they're in the UK. About, I think it was about 85% of their buildings are supported by totally renewable energy or very low carbon energy. So they really focus on that environmental building, sustainable building space. And hopefully we'll have some affordable housing one day.
So I think we're all back in the main room, and we're at the end of the session. I mentioned before, as we were switching over breakout rooms, we'd really appreciate your feedback on this session, whether you thought it was helpful, any improvements we can make. We are trying different formats and experimenting a bit on how we can bring you and engage with you around the Encasa Fund. So any comments you have would be great. There is a poll on the screen, which I think we're all being encouraged to respond to. I do want to thank Wayne, Diane, Mike, Brian for your time today and your ongoing engagement with Encasa. I think bringing you and your companies in as sub-advisors have really provided us with great service and really allowed us to become much more an improved product for our investors, and also obviously being much more able to deliver on our responsible investment commitments. So thank you for that. Thank you again for your time, and thank everybody else for your time today, and those at Encasa who helped bring this this session about. By a large majority, you know, we see that people like the breakout session piece. Any other feedback you can provide to us is welcome. And be safe in the rest of your day and the rest of the weeks ahead and the months until we all achieve herd immunity. Take care, and thanks again for this today.